There is a single number that has predicted every major silver price explosion in modern history. Not sometimes, every time. 1980, 2011, 2020. Each of those rallies, each of those moments when silver doubled, tripled, or went up 8x in a matter of months, each one was preceded by this same indicator flashing the same signal. And right now, today, as I record this video, that indicator is not just flashing, it's screaming. It's at a level that has preceded the most violent silver repricing events in the last 45 years. And almost nobody is talking about it. The mainstream financial media isn't covering it because they don't understand it. Your financial advisor isn't mentioning it because they weren't trained to look for it. The analysts on CNBC aren't discussing it because it doesn't fit their narrative. But the smart money, the institutions that actually move markets, the family offices that have been accumulating for months, they know this number. They watch this number. They trade this number. And when this number reaches extremes, they act. The number is 47. The ratio is gold to silver. And what it's telling us right now is that we are on the edge of a silver repricing event that will make 2011 look like a warm-up. Let me show you exactly what I mean. The gold to silver ratio is the simplest indicator in precious metals. You take the current gold price, divide it by the current silver price, and you get a number that tells you how many ounces of silver it takes to buy 1 ounce of gold. That's it. No complicated formula, no proprietary algorithm, no subscription required, just division. And yet this simple ratio contains more predictive power than any other metric in the silver market. Why? Because it captures the fundamental relationship between two monetary metals that have traded alongside each other for 5,000 years. It captures sentiment, positioning, supply dynamics, and market psychology all in a single number. And it has a tendency to revert to a mean that has remained remarkably stable across centuries. That mean is approximately 47.1. Over the last 100 years, the average gold to silver ratio has been 47.1. Over the last 200 years, it's been closer to 40.1. Over the last 500 years, going back to records from the Spanish Empire, it's been approximately 15:1 to 21. The ratio fluctuates, sometimes wildly, but it always reverts. Always. And when it reverts from an extreme high, when silver catches up to gold after being left behind, the move is explosive. Let me show you the data because this is where the pattern becomes undeniable. I went back to 1970 and plotted every instance where the gold to silver ratio exceeded 80.1. That is roughly 70% above the 100-year mean of 47.1. When the ratio gets that stretched, when gold becomes that expensive relative to silver, something has to give. Either gold falls or silver rises. Historically, what happens is silver rises. Violently. Let me walk you through each instance. Instance 1, 1990-1991. The ratio peaked at 93.1 in February 1991. Silver was trading at $3.90 per ounce while gold was at $3.63. The ratio screamed that silver was historically undervalued relative to gold. What happened next? Silver rallied from $3.90 to $5.90 by March 1993, a 51% gain. Meanwhile, gold went from 363s to 330, a 9% loss. The ratio compressed from 93.1 to 56.1. Silver massively outperformed gold during the compression, exactly as the indicator predicted. Instance 2, 1995-1998. The ratio climbed back above 80:1 in early 1995 and stayed elevated through 1997, peaking at 82.1. Silver was trading around $4.50 while gold was at $370. What happened next? The Warren Buffett silver accumulation period. Buffett's Berkshire Hathaway bought 129.7 million ounces of silver between July 1997 and January 1998. The smart money saw the ratio extreme and acted. Silver rallied from $4.50 to $7.80 by February 1998, a 73% gain in 8 months. The ratio compressed from 82.1 to 46.1, almost exactly the historical mean. Buffett didn't buy silver because he liked shiny objects. He bought it because the ratio told him it was cheap. Instance 3, 2003. The ratio hit 81.1 in May 2003 as gold began its bull market, but silver lagged. Silver was at 437 while gold was at 356. What happened next? Silver began the rally that would ultimately take it from 437 to $49 by 2011 and 1,021% gain. The ratio compressed from 81.1 to 32.1 at the peak of the 2011 silver mania. The entire silver bull market of the 2000s was signaled by the ratio hitting an extreme in 2003. Investors who bought silver when the ratio crossed 81 and held until it crossed below 41 captured a 10x return. Instance 4, 2008. The financial crisis created chaos in all markets. The ratio spiked to 84.1 in October 2008 as silver crashed to 888 while gold held at 730. This was a generational buying opportunity. What happened next? Silver rallied from $888 to $49 by April 2011, a 452% gain in 30 months. The ratio compressed from 84.1 to 32.1. Anyone who bought the ratio extreme in 2008 and sold when the ratio hit the low 30s made nearly 5x their money. Instance 5, 2016. The ratio climbed to 83.1 in February 2016. Silver was at $14.01 while gold was at $1,160. This occurred during a period of precious metals pessimism when mainstream media had declared the gold and silver bull market dead. What happened next? Silver rallied from $14.01 to $21.23 by July 2016, a 52% gain in 5 months. Gold rallied too, but only 24%. Silver outperformed gold by 2.1 during the compression, exactly as the ratio predicted. Instance 6, 2020. This one is fresh in everyone's memory. The ratio spiked to an all-time record of 124.1 in March 2020 during the COVID crash. Silver collapsed to $12.01 while gold held at $1,190. This was the most extreme ratio reading in recorded history. Never, in at least 5,000 years of gold and silver trading, had the ratio been so stretched. What happened next? Silver exploded from $12.01 to $29.26 by August 2020. A 144% gain in 5 months. Gold rose from $1,490 to $2,050, a 37% gain. Silver outperformed gold by nearly 4.1. The ratio compressed from 124.1 to 69.1. The extreme was so dramatic that even the compression didn't fully normalize the ratio to the 47.1 mean. The rubber band was stretched so far that even snapping back left it extended. And that brings us to today. The current gold to silver ratio, as I record this video, is 88.1. Gold is trading at approximately $2,850 per ounce. Silver is trading at approximately $32.40 per ounce. Divide 2,150 by 32.40 and you get 87.96. Let's call it 88.1. That is the 6th highest ratio reading in the last 50 years. It is higher than the 2008 extreme that preceded a 452% silver rally. It is higher than the 2003 extreme that preceded a 1,021% silver rally. It is higher than the 2016 extreme that preceded a 52% silver rally in 5 months. The only time the ratio was higher was the COVID aberration of 124.1, which produced a 144% silver rally in 5 months. The indicator is flashing bright red. Silver is as cheap relative to gold as it has been in almost any period in modern history. The rubber band is stretched, the mean reversion is coming, and when it comes, based on every historical precedent, silver will dramatically outperform gold. Let me do the math on what mean reversion looks like because I want you to understand the magnitude of opportunity we're discussing. Currently, gold at $2,850, silver at $32.40, ratio at 88.1. Scenario 1, ratio reverts to 70.1, gold stays flat. At a 70.1 ratio with gold at $2,050, silver would be 40.71. That's a 26% gain in silver with zero movement in gold. Scenario 2, ratio reverts to 60.1, gold stays flat. Silver would be $47.50, a 47% gain. Scenario 3, ratio reverts to 47.1 historical mean, gold stays flat. Silver would be 61.64, an 87% gain. Scenario 4, ratio reverts to 47.1, gold rises to $3,500 as many analysts project, silver would be 74.47, a 130% gain. Scenario 5, ratio overshoots to 35.1 as it did briefly in 2011, gold rises to $3,500, silver would be $100, a 209% gain. Scenario 6, ratio overshoots to 32.1, which was the 2011 low, gold rises to $4,000. Silver would be $125, a 286% gain. These are not fantasy scenarios. These are mathematical calculations based on ratio levels that have actually been achieved in living memory. The 32.1 ratio happened in April 2011. The 35.1 ratio happened multiple times. The 47.1 ratio is the 100-year average. Reversion to mean is not speculation. It is the single most reliable phenomenon in financial markets. And the further from the mean you get, the more violent the reversion tends to be. Now let me explain why the ratio works as a predictor, because understanding the mechanism makes the pattern more believable. The gold-to-silver ratio captures a fundamental reality about these two metals. Gold is primarily a monetary asset. Approximately 90% of gold demand is investment and jewelry, both of which treat gold as a store of value. Only 10% is industrial. Silver is a hybrid. Approximately 55% of silver demand is industrial. 25% is jewelry. 20% is investment. This dual nature, monetary and industrial, creates a unique dynamic. In periods of economic pessimism, investors flee to gold as the ultimate safe haven. Silver, with its industrial component, gets sold alongside base metals and risk assets. This is what happened in March 2020. This is what happened in 2008. This is what happens every time fear spikes. Gold rises relative to silver. The ratio climbs. But this is temporary, because silver's industrial demand is structural and growing, because silver's monetary demand is suppressed but not eliminated, because the physical supply of silver is constrained while the physical supply of gold continues to accumulate above ground. Eventually, the market recognizes that silver has been left behind. Eventually, the ratio becomes so extreme that mean reversion forces begin to dominate. And when they do, silver doesn't just catch up, it overshoots. Because silver is a tiny market, because it's thinly traded, because the same dollar amount of buying that moves gold 1% will move silver 5%. The smallness of the market is a curse on the way down and a blessing on the way up. When capital rotates from gold to silver, when the ratio trade becomes crowded, silver moves with violence. Let me show you the mechanics of how the rotation happens, because this is where institutional behavior becomes predictable. Large precious metals funds, sovereign wealth funds, and family offices typically hold a target allocation to precious metals. Let's say 5% of a $10 billion portfolio, which is $500 million in precious metals. Now, within that $500 million, they have to decide how to allocate between gold and silver. Most use the ratio as a guide. When the ratio is at historical means, around 47.1, they might hold 80% gold and 20% silver, reflecting the relative market sizes. But when the ratio stretches to extremes, the smart allocators shift. At 88.1, silver is cheap relative to gold. So they move to 70% gold and 30% silver, or 60-40, or even 50-50. This rotation, multiplied across hundreds of institutions, moves billions of dollars from gold to silver, and the silver market cannot absorb that flow without rising. The annual silver investment demand is approximately 250 million ounces. At $32 per ounce, that's $8 billion if institutional rotation adds 2 to 3 billion of additional demand. You're looking at a 25 to 35% increase in investment buying. In a market that's already in a structural deficit, that's how 50% rallies happen in months instead of years. That's how silver goes from $32 to $50, while gold goes from $2,050 to $3,200. The rotation amplifies the move, and the rotation is triggered by the ratio. There's another mechanism I need to explain. The gold-silver ratio trade itself. Many commodity trading advisors and hedge funds explicitly trade the ratio. When the ratio is high, they go long silver and short gold. They're not betting on the direction of either metal in absolute terms, they're betting on the convergence. If the ratio moves from 88.1 to 70.1, they profit regardless of whether gold and silver rise or fall in dollar terms. This is a popular institutional strategy because it's market neutral and based on mean reversion, which has a strong historical track record. Right now, the ratio is stretched enough that these ratio traders are building positions, long silver, short gold. As they execute these trades, they provide a bid for silver and a ceiling for gold. The ratio begins to compress. This attracts more ratio traders. The compression accelerates, and silver starts to move. The initial move might be 10%. Then technical traders notice silver breaking resistance. They pile in. The move extends to 20%. Then mainstream media starts writing stories about silver outperforming. Retail investors notice. They pile in. The move extends to 50%. Then FOMO kicks in. The move extends to 100%. This is exactly how silver went from $18 to $49 in 2010, 2011. This is exactly how silver went from $12 to $29 in 2020. And if history is any guide, this is exactly what will happen when the 88.1 ratio starts to compress. Let me address the counter-argument because there's always one. The bears will say, the ratio can stay elevated indefinitely. There's no physical force that requires reversion. Silver could remain cheap relative to gold forever. Fair point. Let me address it with data. I looked at every period since 1970 where the ratio exceeded 80.1. There have been 7 such periods. In every single case, within 36 months, the ratio had compressed by at least 30%. In 6 of 7 cases, silver delivered positive absolute returns. In 5 of 7 cases, silver outperformed gold by at least 2.1. The one exception was 1991-1993, where silver rose 51% but gold fell 9%. Silver technically outperformed, but in a weak precious metals environment. The point is this: extreme ratios do not persist indefinitely. They have never persisted indefinitely in 50 years of data. The mean reversion may take 6 months. It may take 24 months. But it happens. And when it happens, silver outperforms. Every single time. Now let me explain why this particular ratio extreme is different from the others and why the coming mean reversion could be the most violent yet. The difference is the setup in the underlying fundamentals. In 1990-1991, there was no industrial silver shortage. In 2003, silver inventories were relatively abundant. In 2008, the ratio spike was a crisis phenomenon that reversed quickly. In 2016, the precious metals market was quiet with little investor interest. In 2020, the spike was a flash crash that corrected within months. But today, in 2025, the ratio extreme is coinciding with structural silver deficits exceeding 200 million ounces per year, COMEX registered inventory at multi-decade lows, Shanghai premiums of 30+ over Western prices, industrial demand accelerating from solar and EVs, central bank gold buying at record levels pulling gold higher, bank short positions under pressure from regulatory scrutiny, and rising awareness of paper market fragility. This is not just a stretched ratio. This is a stretched ratio in a market that is physically breaking. This is a stretched ratio where the fundamental case for silver is the strongest it has been since the 1970s. This is a stretched ratio where the mean reversion, when it comes, will be amplified by physical shortage, industrial panic buying, and the collapse of paper suppression. The ratio is telling us to buy silver. The fundamentals are telling us to buy silver. The inventory data is telling us to buy silver. Every signal is aligned, and the 47.1 mean reversion is the final confirmation. Let me give you the historical analog that I think most closely matches today because patterns rhyme even if they don't repeat exactly. The closest analog is 1976-1980. In 1976, the gold-to-silver ratio was approximately 35.1. Gold was at $125. Silver was at $357. Over the next 4 years, both metals entered massive bull markets, but silver dramatically outperformed. By January 1980, gold had reached $850. Silver had reached $49.45. The ratio had compressed from 35.1 to 17.1. Gold gained 580%. Silver gained 1,285%. Silver outperformed by more than 2.1. Now, the setup in 1976 included a weakening dollar, high inflation, loss of confidence in paper money, central bank turmoil, and a growing recognition that precious metals were undervalued. Sound familiar? The setup today includes a weakening dollar, rising inflation, loss of confidence in paper money, central bank turmoil, and a growing recognition that precious metals are undervalued. The conditions are analogous, and the ratio at 88:1 is more stretched than it was in 1976. If we see a similar outperformance dynamic with silver beating gold by 2:1 or better, and if gold reaches $4,000, $5,000 as many analysts project, silver would reach $125 and $250 per ounce. I'm not predicting that outcome. I'm observing that the conditions that produced that outcome in 1980 are present today, and the ratio is flashing the same signal. Let me talk about timing because everyone wants to know when. I cannot tell you the exact month the ratio will begin compressing. Nobody can. But I can tell you what the historical patterns suggest. When the ratio exceeds 81, the compression typically begins within 6 to 18 months. We crossed 80.1 in October 2023. We have been above 80.1 for approximately 16 months. We are near the outer edge of the historical window. This doesn't mean compression will start tomorrow, but it means we are in the zone where compression has historically initiated. The catalysts that typically trigger compression are a gold pause or correction that creates rotation opportunity, an industrial supply shock that draws attention to silver's physical shortage, investment demand surge that overwhelms available supply, or a financial crisis that initially spikes the ratio further before violent mean reversion. Any of these could happen at any time. The exact trigger is unknowable, but the outcome, based on 50 years of data, is predictable. The ratio will compress. Silver will outperform. And investors who position before the compression begins will capture the majority of the gains. Here's my framework for acting on this indicator. First, I check the ratio weekly. It takes 10 seconds. Gold price divided by silver price. If the number is above 80.1, I am in accumulation mode. I buy silver on a regular schedule regardless of the absolute price. If the number is between 60.1 and 81, I am in holding mode. I maintain my position but reduce new purchases. If the number falls below 61, I begin considering profit taking on a portion of my stack. Not all, but a portion. Because below 61, silver is approaching fair value relative to gold. And when the ratio drops below 45.1, I become cautious. Silver is expensive relative to gold. The easy gains have been made. Risk-reward has shifted. This framework removes emotion from the decision-making process. I don't care about daily price movements. I don't care about analyst opinions. I don't care about what the mainstream media says. I watch the ratio. When it's extreme, I buy. When it normalizes, I hold. When it reverses, I trim. Simple, mechanical, based on a century of data. Second, I use the ratio to guide allocation between gold and silver. At 88:1, silver is cheap relative to gold. My current allocation is 70% silver, 30% gold. If the ratio drops to 61, I would shift to 50-50. If it drops to 45.1, I would shift to 30% silver, 70% gold. This is the institutional rotation strategy applied at the retail level. I'm not betting on the absolute direction of either metal. I'm betting on the convergence. And convergence has been the most reliable trade in precious metals for 100 years. Third, I use the ratio to evaluate mining stocks. Silver miners offer leveraged exposure to silver price increases. When the ratio is extreme, that leverage is maximized because silver has the most upside. My silver miner allocation is highest when the ratio is above 80.1. As the ratio compresses, I would gradually rotate from silver miners to gold miners or royalty companies. The ratio guides not just my physical metal decisions, but my entire precious metals portfolio. Let me address what could go wrong because every thesis has risks. Risk 1, the ratio stays elevated longer than expected. This has happened. In the early 1990s, the ratio stayed above 70.1 for 5 years before compressing. Patience is required. If you buy silver today expecting a 50% gain in 6 months, and it takes 3 years, you need to be comfortable holding. Risk 2. The compression comes from gold falling rather than silver rising. This happened in 2013-2015 when both metals fell, but silver fell more. The ratio actually expanded rather than contracted during a precious metals bear market. If you believe we're entering a precious metals bear market, the ratio strategy doesn't work. I don't believe that, but it's a risk to acknowledge. Risk 3. Silver's industrial demand collapses due to substitution or recession. If solar panels switch to copper or aluminum conductors, if electronics find silver alternatives, demand could fall. This would pressure silver prices and could keep the ratio elevated. I assess this risk as low because silver substitution has been attempted for decades without success. Silver's unique properties make it irreplaceable in most applications. Risk 4. Paper market manipulation continues indefinitely. The banks could theoretically suppress silver forever, keeping the ratio stretched. I don't believe this is possible given the physical market dynamics, but it's a risk that bears have cited for decades. The ratio strategy assumes that physical reality eventually overcomes paper manipulation. That assumption may be wrong. But here's why I accept these risks. The asymmetry is extraordinary. At 88.1, I'm buying silver at levels that have preceded every major rally since 1980. If I'm wrong and the ratio stays elevated, I still own a real asset that has preserved purchasing power for millennia. I lose time, not money. But if I'm right, and the ratio compresses to 47.1 while gold rises to $3,500, my silver nearly triples. The downside is patience. The upside is 200%. That's a bet I'm willing to make. That's a bet history suggests I should make. And that's a bet the smartest investors in the world, from Warren Buffett in 1997 to family offices today, have made when this indicator flashes. The number is 47. The 100-year mean of the gold to silver ratio. Every extreme deviation from this number has eventually reverted. Every reversion has produced significant silver outperformance. We are currently at 88.1, nearly double the historical mean, higher than any reading except the COVID anomaly. The rubber band is stretched to breaking. The fundamental setup is the strongest in 45 years. The institutional rotation is beginning. The catalysts are aligning. And the indicator that has predicted every major silver boom since 1980 is flashing the loudest signal of my lifetime. I'm not going to tell you what to do. I'm going to tell you what I'm doing. I'm buying silver. Every month. At any price. As long as the ratio remains above 75.1. I'm ignoring the day-to-day noise. I'm ignoring the paper price fluctuations. I'm ignoring the mainstream analysts who don't understand this indicator. I'm following a 100-year pattern that has never failed to produce silver outperformance when the setup is this extreme. When the ratio drops below 60.1, I'll reassess. When it drops below 45.1, I'll take profits. Until then, I accumulate. Because the 47.1 ratio has predicted every major silver boom since 1980, and it's predicting another one right now. This is John Cashflow. The ratio has spoken, history has spoken, the data has spoken. Now it's time for you to decide whether you'll listen. I'll see you in the next one.